Portfolio Builder members, today we sold one half of our Boyle natural gas position for 139% profit. Our top selling advisory is now up 41% year to date for 2022. And that's after returning a total return of 233% in 2021. That means every $10,000 invested turned into $33,000. Now it's time to prepare to sell the second half of Boyle in the coming weeks. Unfortunately, there was an incident in Europe over the last 48 hours that may be used to escalate the conflict. So we're actually expecting things to get worse in April, and this could cause Boyle to go much higher, potentially another doubling from here. Mr. P maybe had a different goal than everyone else had in mind. Perhaps it was to crash the US bond market and dethrone the dominance of the dollar. That's what we've seen is now the ruble's back to the level it was before the conflict, and they have now negotiated trading deals with China and India. So in my opinion, RUSSIA is winning this conflict big time. It's critical that you own 4 stocks to protect your wealth right now. We're going to cover what those are immediately in this video. Here's our current trade alert recommendation for $10,000. Step 1, buy 65 shares of UVXY. That's your stock crash insurance. Okay, if the bond market crashes any further, I guarantee you stocks will fall much, much harder. This could send UVXY up well over 1,000% like it did in 2020 when the world went into lockdown. Here's a look at the VIX, UVXY, and again, it's up to about 14 today. We've seen it as high as 22 this year. That's nothing. This could be going to 200 plus if things get worse in the commodities markets. Step 2, buy 139 shares of TMF. This is a leveraged product playing the 20-year treasury. Okay, just in general, interest rates are at a level that will snap the financial system. These interest rates have been driven by inflation, and the only inflation that's remaining ultra sticky are the costs of food and energy, which is being escalated due to the conflict in Europe, as well as China going into crazy lockdowns right now. They have locked down several 100 million people, and this is causing more supply chain issues. Okay, so furthermore, we've got the US doing everything it can to fight inflation ahead of midterms. We're expecting TMF to eventually break to new highs. We could easily double our money on TMF this year and hold it into next year. Here's a look at the TLT, which is the non-leveraged version of TMF. You can see this is one of the worst drawdowns in history. Not only is it the biggest sell-off in history, it's been going down for almost 2 years. The bond market has an incredible track record of almost never losing money. And that's because the only way debt grows is via interest rates going lower and lower over time. Step 3, buy 164 shares of ETHE. That's our favorite growth asset. We use ticker ETHE to get exposure to Ethereum. And again, I believe we are going to see yields fall and commodity prices fall probably by May, and that we can still avoid a market crash ahead of midterms. So we're still remaining very bullish on Ethereum. Step 3, buy 36 shares of Boyle. This will be a very short play if you're joining us now. We just took 139% profit on half the position. I think it could still double from here if things don't cool off in Europe. And there's that chart of Boyle where we just sold it today. And we got in at the start of the year, watched it double and crash, held, and then it more than doubled back again. And again, this could still go far, far higher if Europe tries to start outsourcing its natural gas away from RUSSIA and over to anyone else. Here's a breakdown of the portfolio. We have 65 shares of UVXY. That represents 9.5% of the portfolio. We've got 139 shares of US Treasuries, leverage times 3, representing 24.5% of the portfolio. And again, I could see a maximum drawdown on TMF of 30%. Okay, and I think it's very, very unlikely it goes much lower than it is today. On the other hand, as energy prices cool off and potentially we see lockdowns in China and the US, expect for energy costs to fall, rates to fall, and for TMF to scream higher. We can at least double our money in TMF this year alone. On the offensive side, we're long Ethereum, the best growth asset in the world. This is like buying Microsoft when it was 5 years old. It's going to take several decades for this product to truly mature and hit its peak market cap. That's a 40% position with 164 shares. And then we're hanging on to half our natural gas inflation hedge of BOIL at 36 shares. Again, expect governments to do everything possible to get inflation down. That's the worst nightmare possible for any government, because high inflation means less debt, and that means governments can't rob the people of as much money. And again, that's essentially their sole purpose of being alive, is to spend as much as they can possibly get their hands on. The bond market's now on the verge of crashing the stock market. Here's a look at that TLT. And again, we were very, very patient. The absolute lowest I see the TLT going without crashing everything around it is 120. And I told you if we got anywhere near 125, we would begin buying it. At 120, we would go essentially all in. I find it highly unlikely it goes much lower than 127. And again, we're playing TMF. Here's the 2-year bond. And again, you can see it's nearly at the peak we saw in 2018 before markets began collapsing and yields fall. So this is a very good opportunity to buy bonds. I thought this would be 2 years from today that we'd be buying this, but the conflict in Europe has accelerated the timeline. Yields and energy prices cannot remain at this level. It will not last. If we look at the chart of oil, we can see it can hit these $100 price levels, but it cannot be sustained for long. Okay, so we're expecting a sharp decline in commodity prices and falling yields in the very near future. The second the conflict officially ends, I'm going to go long a leveraged tech ETF, FNGU. Okay, before the conflict ends, I'm much more confident we can make safe returns with low risk in treasuries. But once the conflict ends, I do think you can make even more money with FNGU. So we could very likely end up selling BOIL and rotating that entire position into FNGU for the high risk portfolio. We'd most likely split it into the triple Q and GBTC for the safe growth strategy. Here's a look at FNGU. It's a 3 times leveraged product playing 12 top tech companies, 2 of which are out of China and are trading at extreme discounts. And again, this one could very likely double your money as well. We're holding off. Tech could still crash much more than it has so far if these interest rates remain elevated much longer. Now, ETHE is actually giving you exposure to Ethereum. And if you had bought Ethereum back in 2017, you'd be up 24,000% today. We've had a 50% correction in the last 6 months. And right now is a beautiful time to pick up this asset at a discount. Also, the last time the US went into a tightening cycle while China expanded credit, Bitcoin returned 4,400%. Here's that chart. Okay, so right now we think it's a beautiful time to own cryptocurrencies and then hedge it with the other positions we've just went over. Now it's critical you watch our webinar every Monday, Wednesday, Friday to be ready for the critical sell alert. You want to know when we're going to dump the other half of BOIL and add it to either TMF if the conflict's not over, or into FNGU if there's a clear resolution in the European conflict. So don't miss the next trade alert. Call Dean now at 505-322-7515. All right, very good. So let's take a look at our return. Return safe growth is up 2% in April, returned 1.67 in March, currently down 1% for the year. It's hanging in there. It wasn't as ballsy with the Boyle position, but it's outperforming the S&P 500 and NASDAQ dramatically. We believe it's going to return a beautiful return to close out the year. The high risk portfolio is now up 5% in April after returning an incredible 24% in March. And we're essentially getting ready to position the exact opposite of how we've had you positioned for the last 15 months. The last 15 months, we're betting on inflation. Now we're betting that there's going to be a deflationary cycle in interest rates coming in. And I think that's going to begin in about 30 to 60 days at a maximum. Okay, we'll look at charts in a little bit. I'm going to hit my news feed. Okay, we want the number to call Dean again. Sure, let me get you that back on the screen. Yeah, so if you want to upgrade or ask questions or get a lifetime membership, call Dean now at 505-322-7515. And yeah, we're not buying FNGU yet. There's still massive downside risk to tech until the conflict really is over. But treasuries are really a win-win. If the conflict gets worse, most likely treasuries go up. And if the conflict is over, then almost certainly treasury yields go down. The NASDAQ really just needs yields to go down with a resolution to the conflict. We'll discuss why that is. But right now, TMF's far safer bet than betting on F&G or the triple Q. And that's because we actually think the conflict's going to get worse in the short term. All right, so let's go ahead and look at our news feed. Durian Timmer of Fidelity says earnings season is just around the corner. Estimates for the first quarter have been holding steady at around 6% year over year. If history is any guide, stocks could get a bounce. The Fed's now talking about rolling off its balance sheet at $90 billion a month and raising interest rates 50 basis points every meeting. Okay, so far their trend has been to talk a lot of talk and then deliver slightly less. And this has been slowing down inflation expectations while making the stock market happy. And Sivan Henrik says, the Fed, we are really serious about tightening faster, but we're ready to pivot dovish at any time. The ruble erases invasion loss. Okay, so here's that crazy chart of the RUSSIA currency crashing and going right back to where it was previously. Zero hedge, pushing stocks to all-time highs for 10 years, did zero to boost broader economic inflation. But now, according to Bill Dudley, crashing stocks will spark deflation because of edible iPads. Fauci says waning immunity is a wild card in the next surge. So we're seeing China do lockdowns, a lot of speculation that we're going to see US start to try to get that monkey business back so they can do mail-in voting. We'll see. That's quite a ways off. The bond market's now pricing in 4 rate cuts after all these rate hikes, expecting a recession in late 2022 or early 2023. US Treasury Secretary Yellen, China should be removed from the World Bank loan program. Here's a chart showing the correlation between the NASDAQ and Bitcoin. And we'll look at FNGU relative to Ethereum in a little bit. Sivan Henrik says, like they're going to let stocks keep tanking right before the midterms. August, September, dovish Fed pivot secured. ECB, the European balance sheet, hit a new high, hitting 8.7 trillion euros. Here's that same 20-year treasury. And again, it's very, very rare that you get a significant sell-off in treasuries for a sustainable time. It has one of the best track records for generating positive returns over the last century. And that's because for Debt to grow, interest rates must fall over time. Extremely confident we're going to be making a load of money on TMF over the next 24 months. The long view says, in many ways, money is similar to free speech. It facilitates acquisition of basic needs, can amplify speech, and is necessary for free movement. In the last 2 years, governments have shown a willingness in crises to create without limit and confiscate without due process. A big sales pitch, in my opinion, for Bitcoin. Greek Fire 23 says slowing growth, rate hikes, 95 billion per month of QT, oil price shock, 8% CPI, and he's shocked people are still bullish. The Biden Fed, quote, just declared war on the stock market. Peter Schiff, if the Fed actually follows through with its commitments to shrink its balance sheet by 95 billion per month and continues to raise interest rates, inflation will still get worse, but both the bond and stock market will crash, ushering in a huge recession and financial crisis. Jim Bianco is looking at the probabilities of rate hikes. We're looking at a 50 basis point rate hike in May, a 50 basis point rate hike in June, another 50 basis point rate hike in July, and less than half of a chance of a similar interest rate hike in September. Almost 11 hikes for 2022 priced in. Again, this would almost certainly, when coupled with quantitative tightening, create massive layoffs and a stock market crash ahead of critical midterm elections. I find this highly, highly unlikely. Jan is saying F&GU can't be bought in Canada. Yeah, just do the triple Q instead. TQQQ is a great replacement for F&GU. Dylan Leclerc says strong hands have been accumulating Bitcoin at a feverish pace. Gordon Chang says whether we recognize it or not, we are at war. Our enemies are R and C. They are attacking us. It would be a good idea to start defending ourselves. I agree. Jessica Nutt says when the Fed says they're going to raise rates to lower inflation, they mean they're going to put a few million people into unemployment. And this is looking at the construction and housing sector as the mortgage interest rates are skyrocketing currently. Your average mortgage payment has doubled from a year ago on the same loan. The US bond market is now down 8.7% from its high in August of 2020, the largest correction we've seen in 25 years. The 10-year Treasury yield has moved from 0.55 to 2.54 during this time. And we were out the entire time. What a remarkable call it will be if we get the exact bottom today. Now, again, I'm unfortunately, I think the yields could go slightly higher and natural gas go much higher in the next 30 days. So I'm expecting up to a 30% drawdown in TMF and up to a double in Boyle before we get the ultimate high in commodities and yields before a massive reversion occurs. But again, timing can be hard, and I'd rather be early than late, which is why we sold half today and have begun this critical new position. China PMIs confirm a more severe slowdown than estimated. Now again, a slowdown in growth means lower yields. Okay, that's why we're buying treasuries at these very high yields. We'll look at that Chinese PMI, but it looks like they are trying to get energy and food costs down, or specifically energy costs down, by shutting down massive parts of China, including Shanghai. Hundreds of millions are now in extreme lockdowns. So far, Europe's still scared to sanction critical energy products from RUSSIA. If they do, expect Boyle to potentially double or triple from here. Former New York Fed President Bill Dudley says the Fed is no longer your friend. They should be actively working to make sure you lose money. If stocks don't fall, Bloomberg says, the Fed needs to force them. The European Union has given $35 billion to RUSSIA for energy supply since the start of the war. Meanwhile, we've sent $1 billion to you to defend. Luke Groman says stocks are down, US Treasury yields are up. Big again today. Equals systemic Achilles heel. The illusion that US Treasury yields are rising solely because US economic data is getting better is vanishing. US balance of payments problem is getting increasingly acute. Paradoxically, this is a positive for the US dollar in the near term. Now, I agree with him. Everything that's happening is going to drive the dollar up until the dust settles, and then expect the dollar to fall. And that's when we're going to really expect our cryptocurrencies to skyrocket. Peter Schiff says the bond market will keep falling until the stock market crashes. If the stock market doesn't crash soon, the bond market will crash instead. Well, the bond market's already crashed, which will cause a stock market crash. Then a Fed pivot will cause a bear market rally in bonds until surging inflation ends the rally. Yeah, what really looks like we're approaching will be more quantitative easing within the next 3 years or less. China's services PMI falls to 42, the lowest since February of 2020, versus 50 the previous month. This is due to lockdowns. There's that crash in the services PMI. We'll look at another PMI in a minute, the composite. Again, China appears to be doing lockdowns simply to get energy costs lower and also to create more inflation in the US by crippling supply chains. It does seem the attack was not to take over which we can't say the word, we'll get banned on YouTube. It looks like the whole goal of this was to cause inflation and create problems for the bond market, which will eventually lead to the US having to print more money to buy its own debt and protect its bond markets. Here's a little thing making fun of Kathy Wood. She was predicting $12 oil, but she meant $12 gasoline. Europe wants to get rid of its dependency on RUSSIA for energy, but it's going to take years. That's what we're expecting to be the slow driver of oil higher, and it's been paying off for us. But if it's used as a war tactic, we could see a spike in those costs. And right now, US energy costs are way, way, way lower than European. So there's still a lot of upside on oil. Extreme upside still ahead for oil without a very, very strong resolution and walk back on sanctions. Dave Rubin says, yes, they're bringing back COVID before elections so they can push mail-in ballots. There's some speculation that the latest variant was a white hat release developed in mice to try to end all the lockdowns. And then we get this PMI from China, and Doomberg says, especially not great when you consider it's made up. Everybody jokes that China makes up their numbers. So for them to print such a low number, obviously on purpose. Jason Brock says, if you watch the YouTube videos on China Insights, they show a lot of evidence of hundreds of millions of Chinese now unemployed in the last 6 to 12 months. Many millions upside down on their mortgages and crazy levels of stagflation on food and energy. Europe's now spending 1/10 of GDP on energy. Again, this is just not sustainable. There's the mortgage rates on 30-year fixed mortgage rate. This breaks down your mortgage payment. The 30-year fixed mortgage rate just passed 5% for the first time since 2011, with the average home price of $500,000 versus $400,000 last year. 30-year fixed mortgage rate at 5% versus 3.3 a year ago. Your mortgage has gone from 2.1 thousand a month up from 1.1 a year ago, 100% increase. So the slowdown is coming almost certainly. Now this is comparing the 3-month 10-year spread to the 2-year 10-year. And so one is inverted, one is not inverted whatsoever. I don't think we're on the verge of a recession in the very near term. We'll look at all this data, and that's why we have not sold the stocks currently. Biden's new SPR release will leave the US with less than 90 days of energy in case there is an emergency. Tavio Costa says, let me get this straight. The Fed just went from being the largest buyer of treasuries to now a seller. Meanwhile, the government is issuing a record amount of debt amidst the worst inflationary problem in 40 years. A major increase in 10-year yield is still ahead. That I do not believe is the case. I believe we are on the verge of yields going any higher, causing disruptions to financial markets. Here's a look at the mortgage rates. You can see the trend in all bond markets is lower and lower yields. And that's because the size of the debt grows, and it's not possible for this to grow without the yields falling further and further. And unless we're going to reduce the government spending, there's no way to stop this trend over the longer course of time. So we could see a little more drawdown in yields, but I think we're very, very close to absolute peak interest rates on just about every bond market there is, at least for this year. 23 cities in China in lockdown, affecting 193 million people. Peter Schiff says if the budget deficit is $2.5 trillion and the Fed adds $1 trillion in quantitative tightening or selling bonds, who will loan the Treasury $3.5 trillion this year at an interest rate less than half of the inflation rate? And what assets will they sell to get the money? The only thing rapid about quantitative tightening will be its end. Peter Zahan says today we're taking a look at MOSKOW's role in supplying our globalized economy with various industrial inputs, iron, steel, aluminum, things we recognize, and then all the parts we don't, but are vital to our daily lives, palladium, cobalt, neon. Those are all critical and high-tech products, especially chips. Reserves of energy are at extreme lows. Definitely going to see higher energy costs. I just think we're due for a pullback before going back higher over the next 12 to 24 months. Luke Groman says it's fascinating to watch the Fed and many market participants engage in collective delusion that they can run the Volcker 1979 playbook with US debts, deficits, and balance of payments akin to the 1920 Europe. When this collective delusion shatters, it will be spectacular. Buy gold and Bitcoin. Fed Volcker couldn't achieve a soft landing when he raised aggressively during high inflation with markets valued at 40% versus GDP and US debt at 30% versus GDP. But we're confident we can achieve a soft landing, raising aggressively with markets valued at 190% to GDP and debt to GDP of 124%. In other words, it does not seem likely the Federal Reserve will actually follow through with much of this extremely hawkish rhetoric. Someone's asking when I think stocks will go up in general, when energy costs go down, especially emerging markets or EDC, which I think is in the next 30 days or less, 30 to 60 days maximum before people will have to concede. I believe we will most likely see a surrender. Juliet Declare says, the masses don't like inflation, yet they've been voting like one man for inflation and will continue to do so. So the fiscal cure for inflation will be more inflation via inflation checks, and the only balancing force will be much higher rates. Zoltan, a ex-fellow over at the Federal Reserve, become very famous as of recently, essentially talking about a major shift in currencies where the trend is to be a country that's either loaded in gold or commodities, and that this will be the primary asset to back currencies in the future. Okay, so Russia's really obviously set up well for that. He's also saying that if the central banks don't bail out commodity traders who've lost a lot of money being in short positions, that it could create a financial crisis and lead to massive QE. And the central banks declined to bail out the commodity traders so far, which means these commodity prices could keep ripping higher until pain does inflict. And this will lead to a bond market crash, which could obviously be extremely harmful to stocks. So essentially, he's predicting volatility leading to more QE. Elon bought out 9.5% of Twitter and has become the largest shareholder. Okay, very good. So that gets us through the hot news feed topics. Here's a look at interest rates. Again, the trend is they go down as debt grows, and the demographics are really bad globally. Essentially, you have too many people retiring and too few skilled workers to pay taxes to pay for all these people retiring. So governments are responding to this by printing money and handing it out for free to win votes. Meanwhile, AI and robotics are also replacing jobs. So in the first time in centuries, technology is hurting the labor markets rather than helping them. So governments, again, are going to keep printing money to stay in power. Here are 30-year mortgage rates going back to 1980. So the big question is this: is the bond market really going to be allowed to crash and melt up to, in this example, nearly 20%? Okay, or are we going to continue this trend probably back down to 0% rates? And at this point, I do think we have one more leg lower in lower rates, another massive quantitative easing push before we potentially get ourselves in a pickle like we had in the 70s. And furthermore, we don't have the labor force to create the sustained inflation for a decade. Okay, we just don't have the working population with the skilled talents to replace what happened in the 70s and 80s. And again, here's mortgage rates over 40 years. They almost always go down. And this move up has been spectacular. So yes, could we see a little bit higher rates? Sure, but not before it starts breaking markets and forcing yields lower. And I thought this move would take 2 years, and it's happened now in 4 months. Ten-year treasuries inverted on the 2 and 10. Now the 3 and 10 are not inverted, so we're getting mixed signaled. Either way, an inverted yield curve typically leads to very nice stock returns over the next 12 to 24 months. And it's the steepening of the yield curve that would concern us. So if we see the 2-year falling, the 30-year rising, that'll be the time to get worried, or just that spread going up. So far, no reason to be concerned. Here's a look at the yield curve in another format, and you can see the 3, 5, and 7 are above the 10 and 30-year. So we're inverted on that portion, but the 3-month is way lower than the 10-year. And this is the more accurate yield curve inversion is the 3-month over 10-year. And the 3-month is being protected by $1.7 trillion sitting in the reverse repo. Okay, so it's very unlikely that 3-month rises until this reverse repo gets drained. Okay, rate hikes we covered with Jim Bianco's data. Right now, the bond market's pricing in massive rate hikes. Here's the VIX futures term structure. And this is just so we understand what the UVXY is. What we want for UVXY to go up is the front month to go above the coming month. So we want the April price to be above the May. And currently it's not in contango, it's in backwardation. Reverse repo is still at $1.7 trillion. Okay, now here's a look at FNGU, Polygon, Bitcoin, and Ethereum. Currently in the safe growth strategy, we're long Bitcoin. In the high risk, we're long Ethereum. In our private equity, which is only offered to paid members, we're long Polygon, which took a little hit with the bond crash today. If I zoom out a little bit, you can see which asset's been the extremely best performing asset. That's Polygon. We're aggressively buying that today for the private equity firm. And if we zoom in a bit, we can see how correlated tech companies are to cryptocurrencies. So I like FNGU a lot for the high risk portfolio. The next trade alert is either going to be TMF or FNGU once we sell more BOIL. If we think there's actually a resolution underway, I like FNGU. If we think natural gas prices are going up so high it's going to crash the financial system, I obviously like TMF. Here's the Tesla to Ethereum comparison, telling us potentially there's a big leg up in ETHE to catch up to Ethereum. These two trades somewhat correlated. And Tesla is one of the only stocks to give Ethereum a run for its money. Here's your TLT, just so you can see, essentially, it pretty much only goes up. And so we're at a very critical level. In my opinion, 120 TLT would crash financial markets. We're at 127. I'd be shocked if we go below 123 before rocket shipping higher for the remainder of the year. Now, TMF is 3 times the TLT. So the potential gain here is at least a double to close out the year. And again, the main catalyst will either be a financial crisis due to the conflict in Europe going outrageous and energy costs going much higher, in which case BOIL and TMF pay off, or the conflict ends, energy costs go down, and then we'd actually expect a better return in cryptocurrencies and FNGU. Okay, your BOIL positions finally outperforming NRGU, at least from this date. Both have been going up very dramatically. Now, BOIL could go up much further. 25% of electricity in Europe is from RUSSIA, natural gas, so it could be used as a weapon. And unfortunately, it does look like things are about to get worse with the European conflict in April and maybe come to a resolution by May. This has been getting much more aggressive than I anticipated and could potentially go on much longer than we originally thought. So carefully monitoring this. There's a new massacre that's being used to try to escalate this. So we'll can't say much on our webinar, otherwise we might get banned by Big Brother. So I'm being pretty generic, but the prediction is the conflict will get worse from here. Lumber futures starting to fall. So I do think the inflation problem is ready to slow down as soon as energy costs come down. So we really need the conflict to end to get very bullish on growth stocks such as cryptocurrencies and FNGU. Here's your dollar index. In general, the conflict is driving value to the dollar. The second this conflict comes to an end, expect the dollar to fall. And that's when we're really going to see that massive liftoff in tech stocks as well as cryptocurrencies. Now, if we look at this period from the dot-com bubble to the 2008 financial crisis, we saw the dollar index go from 120 to a remarkable 72. Now, I'm hoping we can just catch this down to 90 to create some massive profits in our Ethereum position. So we'll take a look at some other charts, this one in particular. So here's where that dollar index fell and where emerging markets outperform US stocks. We saw a 385% return in emerging markets, while the S&P 500 only returned 73%. So I think we're 30 to 60 days out maximum from the dollar topping out and falling. And then that's when we would expect emerging markets to outperform as well as cryptocurrencies. So for anybody worrying about their EDC position. This chart, we're comparing copper to gold prices, not giving us a clear signal. If gold were going up faster than copper, we'd expect lower yields. If copper were going up faster than gold, the opposite. They call it the Dr. Copper. Here's a look at NRGU. That's the top 10 US oil and gas companies leveraged times 3. The yellow line are interest rates. And then the candlestick is the NASDAQ. So we've got your growth on the bottom, the candlestick. You have your interest rates in yellow, and then you have your value play in the oil and gas companies. And so what we can see is as interest rates rose, commodities went up and the NASDAQ fell. What we're expecting for the remainder of the year is the exact opposite. So we're getting you ready to position for lower yields and an outperformance in growth over value over the next probably 12 to 24 months. Here's China's currency. They are in some serious trouble. They're going to need to start printing money to prop up their economy. And so we're expecting to start seeing the Chinese currency devalue against the dollar. So far, it's actually gained against the dollar. In this chart, we're comparing Alibaba, Tencent, and Taiwan Semiconductors to get a feel for when China is going to stop punishing tech companies and start pumping credit into their economy. So we're starting to see that. We can see now over this stretch that Alibaba has gone up 36%, Tencent 19%, while Taiwan Semiconductors have traded flat. If we zoom out a bit, we can see the great underperformance of two titans of China. Alibaba down 59% from recent highs, Tencent down 50%, and Taiwan Semiconductors only down 20%. And so again, this is our cue that we're positioned correctly for emerging markets to really rally, because it's been the Chinese companies holding it back. So we're starting to see that great outperformance, signaling now is the time to add to that position. Here's the European index. This is another play in our safe growth strategy. And what's being priced in is a lot more money printing and a lot more government spending to make up for the disruptions occurring from the European conflict. In our safe growth strategy, we are long 2 extra inflation plays. We're looking for inflation costs in rare earth metals and uranium. And this is to really protect our tech companies. Okay, so especially REMX that produces lithium and cobalt. It's like a very leveraged emerging market play. These are all Chinese companies. And again, it's your Tesla and your Apple that need massive amounts of lithium and cobalt. And there's going to be huge shortages over the next 3 years. This is a very bullish play for us. So long as we don't start a war with China which could happen if they are too aggressive in protecting RUSSIA. So as long as we don't start getting crazy with China, we're going to be very bullish on REMX. Not in gold or silver right now. Right now, there's 10 million jobs and only 500,000 people. So I still see labor growth improving. We still have a strong consumer. So I'm not looking at stagflation in the very near term. When there's a big discrepancy in silver and gold, it would tempt me to buy silver, playing a catch-up trade. So far, we've stayed out of this play, and I think we're nearing a resolution. So I don't see us jumping into gold or silver in the near term. Here's the core inflation rate at 6.4. I'm expecting this to top out at 7 in the next print, which I believe will be next week, perhaps. I'll double check that. So I think it'll be below 7, and then it's going to slowly come down as we see energy costs come down. Previously, I thought this would top out and then fall viciously. So as long as the conflict in Europe is escalating, we're probably going to have sticky inflation, and that's going to be a headwind against that bond market. The jobs keep roaring in. We've got record amount of job openings and not enough workers. So this will probably slow down as we run out of workers. There's some speculation that if you crash the stock market, you'll get more people to return to the labor markets. Here's that labor force participation rate. So we're still below the Trump levels by about 4 million jobs, but this is rising quite rapidly, faster than I anticipated. So this is going to help replace income and keep the economy trucking along, bullish for stocks. Here's the bank credit continuing to go higher and higher. So the inverted yield curve can play with banks, but in general, we're seeing credit expand in the banks, also bullish for stocks. US consumer credit still growing, not much in January. We'll see how the February print comes out. Retail sales continue to grow. Retail sales just hit a new record. Corporations are still projecting big gains on earnings per share. So no reason to freak out with our long stock positions yet. US balance of trade still at a record level, and we're running massive deficits. This leads to a weaker dollar and higher cryptocurrency valuations. With these really high mortgage rates, we still have not seen a crash in new home sales. We're keeping a close eye on that. Here's that PMI, the composite PMI for China crashed from 50 to 44. It's likely going to cause China to print a whole lot of money. So again, we got that same setup from 2016 to 2018, or at least very similar. Much higher inflation today than 2016, and they're talking about being much more aggressive with rate hikes. But so far, all they've done is jump rates by 25 basis points. Here's these balance sheets. US has stopped growing. They're talking about running it off $1 trillion per year. We'll see if they really follow through with that. Meanwhile, Europe continues to grow its balance sheet. Okay, very good. So now we're going to jump into exact asset allocation. And if you're not a paid member, this is where your video ends. There's 3 spots available every day at special pricing. Call Dean now to upgrade at 505-322-7515.